Welcome to Investment Stories, where we delve into the economic narratives shaping our world. Today, we explore the escalating tensions between the United States and China, focusing on the recent tariffs imposed by President Trump and their profound impact on American businesses. The tariff timeline. In recent months, the Trump administration has intensified its trade war with China by imposing a series of tariffs. Notably, a blanket 10% duty has been levied on imports from all countries, with a staggering 145% tariff specifically targeting Chinese goods. These measures have been justified as efforts to protect American industries and address trade imbalances. Immediate business repercussions. The repercussions for American businesses have been swift and severe. Companies across various sectors are grappling with increased costs for imported materials and goods. For instance, small businesses that rely heavily on Chinese imports are facing difficult choices: absorb the higher costs, pass them on to consumers, or find alternative suppliers, which is often easier said than done. Case study: Tomball, Texas. In the small town of Tomball, Texas, the impact is palpable. Local businesses, traditionally supportive of Republican policies, are now expressing concern over the economic fallout. Store owners who depend on imported goods are witnessing shrinking profit margins and are being forced to raise prices, potentially alienating their customer base. Consumer impact. Consumers are not immune to these changes. As businesses adjust their pricing to cope with increased costs, everyday items are becoming more expensive. This inflationary pressure is particularly burdensome for lower and middle-income households, which spend a larger proportion of their income on goods and services. Supply chain struggles. The tariffs have also disrupted global supply chains. Many U.S. companies had adopted a China Plus One strategy, diversifying their manufacturing bases to include countries other than China. However, the broad application of tariffs has complicated these efforts, making it challenging for businesses to find cost-effective alternatives. Looking ahead. As the trade war continues, the long-term implications for the U.S. economy remain uncertain. While the administration aims to bolster domestic manufacturing, the immediate strain on businesses and consumers raises questions about the efficacy of such protectionist policies. Small businesses are often heralded as the backbone of the American economy. They account for 99.9% of all U.S. businesses and employ nearly half of the country's private workforce. But now, many of these enterprises are under extraordinary stress. According to a recent report from the National Federation of Independent Business, NFIB, nearly 41% of small businesses report moderate to severe financial impact as a result of tariff hikes. For businesses that import parts or finished goods from China, profit margins have shrunk dramatically, some even disappearing altogether. Take Midwest Tool and Supply, a small manufacturer of hand tools in Ohio. Their CEO, Janet Hargrove, recently spoke to NPR about how tariffs on Chinese steel imports have pushed their raw material costs up by nearly 20%. "We can't just raise prices overnight," she said. "We're already operating on tight margins. If this continues, we're going to have to lay people off." The tariff rebate mirage. While the Trump administration has touted the possibility of U.S. businesses applying for exclusions or rebates from the tariffs, the process has proven to be convoluted and bureaucratic. Out of more than 53,000 exclusion requests filed with the Office of the U.S. Trade Representative in the last year, fewer than 20% have been approved. For small businesses without teams of compliance officers or trade lawyers, the system is virtually inaccessible. They are left absorbing the full brunt of costs or scrambling to rework their entire supply chains, which is neither cheap nor easy. Retailers cry out. In retail, the squeeze is just as real. A coalition of over 160 U.S. retailers, including giants like Walmart, Target, and Best Buy, have publicly warned that tariffs will lead to significant price increases on everything from electronics to toys to apparel. Best Buy's CFO, Matt Bilunas, recently told CNBC there is no way around it. If the tariffs remain in place, we'll be forced to raise prices for consumers, particularly during the holiday shopping season. That's not good for anyone. Toy makers, especially, are in panic mode. Roughly 85% of toys sold in the U.S. are manufactured in China. With the holiday season approaching, these companies are facing impossible decisions: raise prices and risk lower sales, or eat the cost and risk bankruptcy. Farmers feel the fallout. Even American farmers, the initial champions of Trump's trade policy, are suffering from the retaliatory tariffs imposed by China on U.S. agricultural exports. China was once the largest market for American soybeans. Now, that demand has plummeted. According to the USDA, U.S. soybean exports to China fell by nearly 70% in 2024 alone. While some farmers received bailout subsidies, many say it's a temporary band-aid on a long-term wound. In states like Iowa, North Dakota, and Missouri, farm bankruptcies are quietly on the rise again, hitting levels not seen since the 1980s. The political cost. Ironically, many of the regions hit hardest by the trade war were also strongholds of Trump's 2016 and 2020 support. Rural towns and industrial cities, where manufacturing and farming dominate, are now reassessing the political narrative. Recent polls conducted by Pew Research show a drop in support for protectionist trade policies among rural voters. A majority now believe tariffs have hurt more than helped their local economies. This erosion of support could have implications in the upcoming elections. When the United States placed tariffs on over $300 billion worth of Chinese imports, China didn't sit idle. It retaliated with its own tariffs, hitting $110 billion worth of American goods. Sectors like agriculture, automotive, and aviation were among the hardest hit. But more importantly, this tit-for-tat approach signaled to the world: global trade is no longer predictable. Economists from the World Bank and the International Monetary Fund, IMF, warn that the decoupling of the two largest economies is already having long-term consequences. The IMF downgraded its global growth forecast, citing the trade war as a primary driver of instability. In its October 2024 report, the IMF stated bluntly, persistent trade tensions have weakened investment and disrupted supply chains. This disruption isn't limited to U.S. companies. Japanese, German, and South Korean manufacturers with operations in the U.S. and China have all reported falling profits and declining market confidence. Wall Street reacts. Markets hate uncertainty, and the Trump tariffs have delivered plenty of it. Every major tariff announcement has triggered a dip in the Dow Jones Industrial Average, with many investors scrambling to reassess portfolio risk exposure. One striking example came in March 2025, when the administration threatened to extend tariffs to consumer electronics. The Nasdaq dropped nearly 3% in a single day, erasing over $300 billion in market value. Apple, which assembles the majority of its devices in China, saw its shares plummet. Larry Kudlow, former director of the National Economic Council, has continued to defend the tariffs as leverage to get a better deal. But analysts on Wall Street are growing increasingly skeptical. We've seen no significant trade deal progress in over a year, said J.P. Morgan economist Julia Coronado. What we're seeing instead is structural damage that will take years to unwind. Global supply chains rewritten. Companies once reliant on China for low-cost, high-volume manufacturing are now being forced to redraw their supply chains. While that might sound like a win for countries like Vietnam, Malaysia, and Mexico, the reality is more complex. Relocating supply chains is not a plug-and-play operation, explains Dr. Henry Su, a professor of international economics at NYU. Factories in Southeast Asia can't match China's infrastructure, workforce scale, or efficiency overnight. What this creates is bottlenecks, delays, and higher costs across the board. A 2025 report from Bloomberg noted that many U.S. manufacturers who moved operations to Vietnam are facing labor shortages and higher than expected production costs. One tech executive quoted in the report said, "We left China because of the tariffs, but what we've run into in Vietnam is chaos. It's hurting our timelines and customer satisfaction." Allies losing faith. Another underreported angle of the Trump-era tariff policy is how it's affected America's relationships with its allies. The World Trade Organization, WTO, ruled in 2023 that several U.S. tariffs violated global trade rules. Rather than comply, the Trump administration has threatened to defund or pull out of WTO mechanisms altogether. European Union leaders have openly criticized the U.S. for its unilateral approach to trade. A joint statement from France, Germany, and the Netherlands in early 2025 warned that America's disregard for multilateral trade norms is creating an atmosphere of economic instability. Meanwhile, Canada and Mexico, America's closest trading partners, have pursued trade deals with China, hedging their bets against a volatile U.S. policy direction. China's pivot and the rise of the yuan. On the flip side, China is not standing still. Beijing has responded to tariffs by accelerating its pivot toward domestic consumption and trade with the Global South. The Belt and Road Initiative (BRI) continues to expand, and China has signed new trade agreements with Africa, Latin America, and Southeast Asia. Perhaps more notably, China is pushing for wider international use of its currency, the yuan, as a way to reduce dependency on the US dollar. In 2024 alone, over 20 new international oil and gas contracts were denominated in yuan instead of USD. While this shift is still in its early stages, it signals a growing desire by nations to move away from American financial hegemony. A nation rewiring its economy. As of early 2025, the Trump administration has not only extended tariffs but has proposed additional duties on critical materials like rare earth elements, semiconductors, and lithium-ion batteries, all central to America's clean energy and tech ambitions. The stated goal? Break U.S. reliance on China. But that pivot will come at a steep cost. A study by the Peterson Institute for International Economics estimates that the continued imposition of broad tariffs on Chinese goods could reduce U.S. GDP by 1.2% annually over the next 10 years. That's the equivalent of more than $280 billion a year lost to lower productivity, higher costs, and global disinvestment. Dr. Chad Bown, senior fellow at the Institute, stated in a March 2025 panel discussion, "We are essentially handicapping our own economy in the name of industrial independence. And while resilience is important, it should not come at the cost of competitiveness. Technology and innovation at risk. Tech firms are among the hardest hit by the prolonged trade conflict. Nearly every major U.S. electronics company, Apple, Nvidia, Intel, and even Tesla, relies on Chinese suppliers for everything from chips to rare metals to advanced component testing. With ongoing tariffs and no clear path toward resolution, companies are either moving operations at great cost, or worse, scaling back research and development spending to preserve margins. The Brookings Institution warns that this could trigger a brain drain, with top-tier tech workers leaving the U.S. for more stable innovation hubs in Europe and Asia. Intel recently shelved a $4.5 billion expansion of its Arizona chip plant, citing uncertainty in global supply chain stability and material costs, exacerbated by trade restrictions. Meanwhile, venture capital investments in U.S. tech startups dropped 11% year-over-year in 2024, with analysts attributing much of that decline to geopolitical instability and tariff-driven market volatility. Inflation, the silent killer. Inflation has long been viewed as the hidden tax on the middle and lower class. The Trump tariffs are, in many ways, turbocharging that effect. With goods from China now significantly more expensive, especially electronics, textiles, machinery, and raw materials, retailers are forced to pass those costs onto consumers. According to the Consumer Price Index, CPI, released in February 2025, the average price of household appliances is up 13.6% compared to the previous year. Clothing is up 9.2%, and tools and machinery, key for blue-collar trades, have surged by over 15%. This is stagflation in slow motion, warns Moody's economist Ron Temple. Sluggish growth, rising costs, and a shrinking middle class. And tariffs are a central contributor to this phenomenon. Employment shifts and labor market friction. As some manufacturing moves out of China and attempts to reshore in the U.S., there's a common narrative that this will revive American factory jobs. But that assumption misses a critical point. Today's manufacturing is highly automated. While a company may open a new facility in Texas or Ohio, the number of jobs created is often a fraction of what would have been the case 2 decades ago. And those that are created often require specialized technical skills not readily available in the current labor pool. The U.S. Bureau of Labor Statistics projects that by 2030, automation will eliminate more jobs than it creates in traditional manufacturing sectors unless there's a significant investment in workforce training. But with federal funding focused on trade battles instead of education, those programs remain underfunded and underdeveloped. Consumer confidence takes a hit. When Americans feel uncertain about their financial future, they spend less. And as tariffs continue to chip away at purchasing power, confidence is beginning to wane. The University of Michigan's Consumer Sentiment Index, a reliable predictor of economic momentum, dropped to a 5-year low in March 2025. The report cited persistent inflation, global instability, and the rising cost of living as core reasons for the drop. Retailers are responding accordingly. Many are scaling back expansion plans or preparing for thinner holiday seasons. Walmart, for instance, recently announced it would not open any new U.S. locations in 2025, the first time in nearly 20 years. Geopolitical fallout and the risk of retaliation. Economically, the U.S. isn't the only one hurting. But politically, it's risking long-term alliances and influence. As America imposes unilateral trade restrictions, countries that once relied on U.S. trade protection like Taiwan, South Korea, and even Australia are seeking new markets and defense partnerships, particularly in Europe and ASEAN nations. A leaked EU Commission memo published by Reuters in February 2025 noted, the U.S. is increasingly seen as an unreliable trade partner. Long-term economic planning must factor in reduced U.S. collaboration. In addition, there's growing speculation that China may begin actively retaliating beyond tariffs, possibly restricting exports of rare earth elements or leveraging its influence in African and South American markets to block U.S. corporate expansion. One of the main criticisms of Trump's China tariffs is their lack of strategic focus. Rather than targeting sectors where China genuinely poses a national security threat, like telecom infrastructure or AI-driven defense tech, the tariffs have been blanket-wide, affecting everything from toys to tractors. Several leading economists, including Paul Krugman and Jason Furman, former chair of the Council of Economic Advisors, have proposed a more surgical approach. Remove tariffs on low-sensitivity consumer goods to alleviate inflation pressure. Maintain or increase targeted tariffs on strategic tech sectors. Strengthen alliances with global democracies to form multilateral trade defenses against unfair practices rather than going it alone. According to a March 2025 report by the Council on Foreign Relations, if the U.S. worked collaboratively with the EU, Japan, and South Korea on trade enforcement, it could isolate Beijing economically without hurting its own citizens. But Trump's unilateral style has strained those relationships, making such cooperation harder, though not impossible. 2. Reinvesting in supply chain resilience, not isolation. Another promising direction is supply chain diversification, not to retreat from globalization, but to spread risk more effectively. For example, instead of relying on Chinese factories for 80% of a product's parts, companies could source 30% from Vietnam, 30% from India, and 40% from the US or Mexico. This doesn't eliminate globalization, it modernizes it. The Biden administration laid the groundwork for this in 2022 with the CHIPS Act and follow-up infrastructure bills, but Trump's return to power in 2024 paused or redirected many of these initiatives. As of April 2025, some congressional Republicans are pushing to restore elements of those efforts, focusing on American-led global production, which includes tax breaks for companies sourcing from allies. Supporting small businesses, the forgotten victims. While big corporations can eventually absorb or shift production, small businesses, the backbone of the U.S. economy, are far less equipped. From boutique clothing brands to hardware suppliers, many rely on Chinese imports and have razor-thin margins. In January 2025, the U.S. Chamber of Commerce called for a tariff relief fund for small businesses similar to pandemic-era aid programs. Modeled after the Paycheck Protection Program, PPP, this fund would offer temporary subsidies to cover cost increases due to tariffs, provide consulting to help shift to new supply chain partners, allow tax credits for companies investing in domestic manufacturing tools. The White House has yet to endorse this plan, but bipartisan interest is growing, especially as the 2026 midterms approach and small business owners voice frustration. 4. Educating and preparing the workforce. As noted in Part 4, the jobs of the future won't be the same as the jobs of the past. Building new factories is great for headlines, but if Americans don't have the training to fill those roles, the benefits are minimal. That's why experts argue that massive reinvestment in vocational education, technical training, and STEM programs is vital. The National Skills Coalition estimates that 54% of U.S. jobs require more than a high school diploma but less than a 4-year degree, yet only 43% of Americans have that level of training. In March 2025, governors from Texas, Michigan, and North Carolina proposed a federal state skills pact to use tariff revenue for job retraining programs. Advocates argue that this will both offset economic pain and prepare Americans for a restructured economy. 5. Rebuilding global trust. Perhaps the most difficult task ahead is restoring the credibility of the U.S. as a reliable economic partner. In a globalized economy, no country can truly isolate itself and thrive. The U.S. needs to rebuild diplomatic and trade relationships not just for prosperity but to maintain geopolitical influence in an increasingly multipolar world. Trade experts suggest rejoining major multilateral agreements like the Comprehensive and Progressive Agreement for Trans-Pacific Partnership (CPTPP), which could give the U.S. more leverage over China without going to trade war. "We need to be in the room where global trade rules are written," said former WTO Deputy Director General Alan Wolf in a February 2025 address. "Otherwise, we'll be subject to rules made by others and we'll lose the ability to protect our own workers and industries."